Welcome to the Company Value Investor channel. In today's video, we are going to focus and analyze the Netflix company. And the way we are going to do it is by focusing on the company itself, not the stock, using fundamental analysis, meaning utilizing the company's financial statements to analyze it. We are going to analyze it for a 4-year period, and we will, at the end of the video, provide a recommendation or opinion based on the analysis. A few things that I want you to remember or keep in mind is, one, if you like the topic and you want more videos, please subscribe. If you like this particular video, thumbs up. If you don't like this video, thumbs down. If you can leave me any type of comment, I would greatly appreciate it. And the last thing I would like you to know is that I am not affiliated with anyone. I am only giving out opinions based on my analysis, and I do have a strong financial analysis background. The symbol for Netflix is NFLX. Currently, the price per share is $159.41. The 52-week low, $84. The 52-week high, $161. In 2016, this is the current stock information. On the left side, we have the financial ratios. Most financial gurus or experts utilize these ratios to conduct their own analysis. I encourage you to, if you have any questions or concerns or doubts, please compare my ratios to your own analysis based on the financial statements of the companies analyzed. We are going to analyze the company using the 4 pillars. The number 1 is the rate needed. Number 2 is the amount expected. Number 3, amount made. And number 4, the amount needed. So for 2016, Netflix needed to make at least 12% in order to meet the expectations of both the creditors and its owners. The amount expected, number 2, is the amount of capital that the company must earn in order to meet all of its obligations. Any positive number here shows, one, that it is an excellent performer or that it had a very good year. And number 3, the amount made. This is the company's real earnings, not the net profits that they show on their statements, but the real earnings. And the last one, number 4, is the amount needed. This is the amount needed by the company in order to run their daily operations for the entire year. So in 2016, we see that it's a positive. This means that the company, Netflix, had an excess amount of capital, meaning that they were well managed through their operations. However, they have a negative here, a negative amount expected, and a negative real earnings. Usually it's the other way around. You have positive here or positive here, negative here. But in this case, is reversed. The issue that I have with these numbers are that because these two are negatives, it's basically telling me that it is not a good performer and it did not have real earnings, but overall they had enough capital to run their operations smoothly, that they didn't have to go elsewhere to maintain their operations. So 2016, not a good year, only because they didn't meet the expectations or the obligations, and they really didn't have any real earnings. Let's go to 2015. 2015, 12%, a negative 505, negative earnings. Again, we have a positive amount here. This tells me the same thing earlier from 2015 and 2016, practically the same numbers. So at the end, 2015 and 2016 were not good years. Let's go to 2014, 15%, negative 214, positive earnings, and positive here. I'm always looking for at least 2 positives, whether they're from number 2, the amount expected, or number 3, the amount made. But in this case, we have it on number 3, the amount made, and the amount needed. This is a very good year. They had excess amount capital, meaning that they didn't need to go outside, and they had real earnings. So 2014 is the best year so far. In 2013, 16.2%, negative 193, positive earnings of 2 million, and then positive here. So overall we have two positives. The problem that I have with this is that the two positives came in 2013 and 2014. 2015 had two negatives and 2016 had two negatives. So overall, would I invest in the Netflix company? No, I wouldn't. Only because they did not have consecutive positive numbers the later years, 2015 and 2016. And the reality is, even though they had very good amounts when it came to their operations, they really didn't have any real earnings, and they never really met the expectations or the obligations of their creditors and their owners. So the question is, would I invest in this company? No, I would not. I think that if they manage to meet their obligations in the next 2-3 years, it will make them a very profitable company, and at that point my opinion about this company would change. But as of now, as of today, I would not invest in this company. That is it for this video. If you have any questions, please email them. If you want me to analyze a company, send me the name and I will do a video. That is it. Remember, keep investing.